So you want to invest in property. Maybe you've heard people talking about making money in real estate. Maybe you've watched property prices climb year after year and thought you're missing out. Maybe you're tired of putting money in the bank and earning almost nothing in interest. Whatever your reason, you're thinking about taking the plunge into property investment, but you have no idea where to start. This video is for you. I'm going to walk you through everything a complete beginner needs to know about investing in Australian property. By the end of this guide, you'll understand why property investment works, how to know if you're ready, how much money you actually need, how to choose the right property, how to finance your investment, and, most importantly, how to avoid the expensive mistakes that trip up beginners. Let's start with the basics. Why invest in property? Before we get into the how, you need to understand the why. Why do so many Australians choose property as their investment vehicle instead of shares, managed funds, or just keeping money in the bank? Property investment works because of three powerful forces that build wealth over time. The first is capital growth. This means your property increases in value over the years. Australian property prices have grown an average of 6.4% per year over the past 30 years. That might not sound exciting, but let me show you what it means. If you bought a property for $500,000 and it grows at 6.4% per year, in 10 years it's worth about $940,000. That's $440,000 in profit. In 20 years, it's worth $1.77 million. That's $1.27 million in profit. And here's the key. You didn't have to do anything except own it and hold it. The second force is rental income. When you own an investment property, you rent it out to tenants. They pay you rent every week or month. This rental income helps you pay your mortgage and other costs. In some cases, the rent covers all your costs and you make money every month. In other cases, the rent covers most costs and you pay a small amount out of your pocket. Either way, tenants are essentially paying off your mortgage for you while you build equity in the property. The third force is leverage. This is where property investment gets really powerful. Leverage means using borrowed money to buy an asset. Banks will lend you 80 to 90% of a property's value. So you might put in $100,000 of your own money, the bank lends you $400,000, and you buy a $500,000 property. When that property grows 6.4% in a year, it increases by $32,000. But you only put in $100,000 of your own money, so you've made a 32% return on your money, not 6.4%. That's the power of leverage. You're earning returns on the bank's money as well as your own. Property also has tax benefits. Negative gearing means if your property costs more to hold than you earn in rent, you can claim that loss against your other income and reduce your tax. Depreciation means you can claim deductions for the property's building and fixtures wearing out over time. These tax benefits put money back in your pocket every year. Finally, property is tangible. You can see it, touch it, and control it. You can improve it through renovation. You can't do any of that with shares. This psychological benefit matters to many investors who like having a physical asset. Are you ready to invest? Not everyone is ready to invest in property right now, and that's okay. Jumping in before you're ready is worse than waiting until you are ready. Here's what you need to have in place before you seriously consider property investment. First, you need stable income. Investment properties require monthly mortgage payments, rates, insurance, and maintenance costs. You need reliable income to cover these expenses, especially in months when the property might be vacant between tenants. If your job is unstable or you're on a temporary contract, wait until you have more security. Second, you need to have paid off bad debt. If you're carrying credit card debt at 20% interest or personal loans at 12% interest, pay those off before investing in property. Property might earn you 6 to 7% growth, but you're paying 20% on credit card debt. The math doesn't work. Clear expensive debt first. Third, you need an emergency fund. Unexpected things happen with investment properties. Hot water systems break. Tenants leave and you have vacancy. Roofs leak. You need cash reserves to handle these situations without financial stress. Aim to have at least $10,000 to $15,000 in readily accessible savings as an emergency buffer. Fourth, you need to understand that property investment is long-term. You're not going to buy a property and flip it for profit in 6 months. Property is a 7 to 10-year minimum investment, ideally much longer. If you need your money back in 2 years, don't invest in property. The transaction costs of buying and selling make short-term property investment unprofitable. Fifth, you need emotional stability. Property investment can be stressful. You might have problem tenants. Properties might need expensive repairs. Market values might drop temporarily. You need to be able to handle this stress without panicking and selling at the wrong time. If you have stable income, no bad debt, an emergency fund, a long-term mindset, and emotional resilience, you're probably ready to start seriously investigating property investment. How much money do you actually need? This is the question everyone asks. The answer depends on several factors, but let me give you realistic numbers. To invest in property, you need a deposit. Most banks require at least a 10 to 20% deposit for investment properties. If you're buying a $600,000 property, that's $60,000 to $120,000 you need saved. However, the deposit isn't all you need. You also need money for buying costs. Stamp duty is the big one. In most states, stamp duty on a $600,000 property is around $25,000 to $30,000. You can't borrow this money. You need to pay it up front. Then there are legal fees of around $1,500 to $2,500, building inspections around $500 to $800, and potentially buyer's agent fees if you use one. Let's do the math on a $600,000 property. 20% deposit is $120,000. Stamp duty is approximately $26,000. Legal fees, inspections, and other costs are about $3,000. Total upfront cash needed is around $149,000. That's a lot of money. Most beginning investors don't have $150,000 sitting in the bank. So how do people actually invest? The most common way is using equity from an existing owner-occupied home. If you already own your home and it's increased in value, you might have built up equity you can access. For example, if your home is worth $800,000 and you owe $400,000 on the mortgage, you have $400,000 in equity. Banks will let you borrow against some of that equity to use as a deposit for an investment property. This is how many people buy their first investment property without needing $150,000 in cash. Another option is buying with a smaller deposit. Some banks will lend up to 90% of the property value for investment purposes if you have good income and credit history. This means a 10% deposit instead of 20%. On a $600,000 property, that's $60,000 instead of $120,000. However, with less than 20% deposit, you'll need to pay lender's mortgage insurance, which can cost $15,000 to $30,000 depending on the loan size. This insurance protects the bank, not you, but it's mandatory if you have a small deposit. Some investors buy with partners or family members to pool resources. If you and your sibling each have $75,000 saved, together you have $150,000 and can afford that $600,000 property. Realistically, to invest in property as a complete beginner, you need either $80,000 to $100,000 in cash savings, or you need equity in an existing property you can access. If you don't have either, you need to focus on saving or building equity in your first home before you can invest. Investment property versus owner-occupied property. This is a crucial concept beginners often misunderstand. An investment property is not the same as the home you live in. They serve completely different purposes, and you need to evaluate them differently. Your home, the property you live in, is about lifestyle. You choose it based on where you want to live, what size you need, whether you like the street, and how it makes you feel. Emotional factors matter. You might pay extra for a home in a great school zone or near your favorite beach, even if it's not a great investment. An investment property is purely about money. You choose it based on one question only: will this property make me money through capital growth and rental return? You don't care if you like the suburb. You won't be living there. You don't care if the house is pretty. Tenants rent houses that are functional and well located, not houses that are pretty. Emotional factors should not influence investment property decisions at all. Many beginners make the mistake of choosing investment properties the same way they'd choose a home. They buy in suburbs they like, or they buy properties with features they personally want. This is wrong. You need to think like an investor, not like a home buyer. Investment properties should be chosen based on data, rental yields, capital growth history, vacancy rates, population growth, infrastructure investment, and employment opportunities. We'll cover how to analyze these factors later, but for now, understand that investment properties are business decisions, not lifestyle decisions. Where should you buy your first investment property? Location is everything in property investment. A great property in a terrible location will perform badly. An average property in a great location will perform well. So how do you choose the right location? For beginners, I always recommend buying in capital cities rather than regional areas. Capital cities have larger populations, more diverse economies, better infrastructure, and more stable long-term growth. Regional areas can boom, but they can also bust. Capital cities are more reliable. Within capital cities, you need to understand the different suburbs and what makes them good or bad investments. Expensive inner-city suburbs close to the CBD offer lifestyle appeal, scarcity, and high rents, but growth can be slower because they're already expensive. These suburbs are good for experienced investors with large budgets who want stability. As a beginner, you probably can't afford these areas anyway. Middle ring suburbs, 10 to 20 kilometers from the CBD, often offer the best balance of affordability and growth. Look for suburbs that are gentrifying, meaning they're improving as younger people move in, cafes open, and the area gets trendier. These suburbs offer strong growth potential at prices beginners can afford. Outer suburbs, beyond 25 kilometers from the CBD, are the most affordable, but have slower growth and lower rents. These can work if they have good infrastructure, like train lines and employment centers nearby. Avoid outer suburbs that are entirely car-dependent with no local employment. Growth corridors are areas where governments are building new suburbs with thousands of new houses. These areas are very affordable, but have limited growth because so much supply is being added. The new houses compete with your investment property, keeping growth slow. How do you identify good suburbs? Look for these factors. Population growth. Is the suburb's population increasing? Growing populations mean more housing demand. Employment. Are there jobs in or near the suburb? People need to work. Suburbs near employment centers have stronger rental demand. Infrastructure. Is there a train station, good roads, shops, and schools? Infrastructure makes suburbs livable and desirable. Scarcity. Is new housing being built in the suburb? If thousands of new houses are being added, growth will be slow because supply is increasing. Rental demand. Is the rental vacancy rate below 2%? Low vacancy means strong demand, which supports both rents and property values. Price trends. Has the suburb been growing steadily over the past 5 to 10 years? Past growth doesn't guarantee future growth, but it indicates the suburb has good fundamentals. Use online tools like realestate.com.au, domain.com.au, and government websites to research suburbs. Look at median prices, rental yields, vacancy rates, and population data. Spend time researching before you buy. Houses versus units. Which should you buy? Beginners often wonder whether they should buy a house or a unit for their first investment. The answer depends on your budget and goals. Houses typically offer better long-term capital growth because you own the land, and land increases in value over time. Houses also give you more control. You can renovate, extend, or even subdivide if the block is large enough. Houses usually attract longer-term tenants like families, which means less turnover and more stable rental income. However, houses are more expensive to buy and more expensive to maintain. You're responsible for everything: the roof, the yard, the fences, the driveway. Maintenance costs can be significant. Units are more affordable, making them accessible to more beginning investors. Units are lower maintenance because the body corporate handles building maintenance, gardens, and common areas. Units often have better rental yields because they're cheaper to buy but still rent for decent amounts. And units are often in better locations, closer to city centers and public transport. However, units typically have slower capital growth than houses in the same area because you're mainly buying the building, not the land. You have less control over units. You can't extend or subdivide. You have to deal with body corporate rules and politics. And you pay strata fees, which can be $1,000 to $3,000 plus per quarter, adding to your costs. For most beginners, I recommend considering units if your budget is under $700,000. Units in that price range in good suburbs, close to public transport and employment centers, can deliver solid growth and good rental yields. If your budget is above $700,000, houses in middle-ring suburbs become more viable and offer better long-term growth potential. New versus established properties. Another common question is whether to buy new properties or established older properties. New properties have several advantages. They need no immediate maintenance or repairs. Everything is brand new. You can claim much higher depreciation tax deductions on new properties because the building and fixtures are all depreciating from new. Some developers offer incentives like furniture packages or rental guarantees. However, new properties have significant downsides. They're typically more expensive than equivalent established properties in the same area. You're paying a premium for new. New properties are often in outer growth areas with lots of supply, which limits capital growth. And new properties often have inflated prices because developers need to make profits. Established properties are usually cheaper than new properties in the same suburb. They're typically in more established areas closer to infrastructure and employment. And you can often add value through renovation or cosmetic improvements. The downsides are that established properties might need immediate repairs or maintenance. You claim lower depreciation deductions, and older properties might have issues like asbestos or old wiring that need addressing. For most investors, established properties in good locations offer better value and stronger growth than new properties in outer areas. The depreciation benefits of new properties don't outweigh the capital growth benefits of established properties in proven locations. Understanding the numbers, yield, growth, and cash flow. As an investor, you need to understand three key numbers: rental yield, capital growth, and cash flow. Rental yield is the rental income you receive as a percentage of the property's value. If you buy a $600,000 property and rent it for $500 per week, that's $26,000 per year in rent. Divided by $600,000, that's a 4.3% rental yield. Higher yields mean more income. Regional areas typically have higher yields of 5 to 7%. Expensive capital city suburbs have lower yields of 2 to 4%. Capital growth is how much the property value increases each year. A property bought for $600,000 that's worth $630,000 a year later has grown 5%. Growth builds your wealth over time. Most properties offer either good yield or good growth, rarely both. Regional properties have high yields but slower growth. Expensive city properties have low yields but stronger growth. As a beginning investor, you want balanced properties offering moderate yield of 4 to 5% and moderate growth of 5 to 7% per year. These properties are typically in middle-ring suburbs of capital cities. Cash flow is whether the property costs you money or makes you money each month. Positively geared properties earn more rent than they cost to hold. Negatively geared properties cost more to hold than they earn in rent. Let's look at an example. You buy a $600,000 property with a $480,000 mortgage at 6% interest. Your monthly mortgage payment is about $2,880, Annual council rates are $2,000, insurance $1,200, strata fees $3,000, and maintenance $2,000. Total annual costs are about $42,560. The property rents for $500 per week, which is $26,000 per year. Your costs are $42,560 and income is $26,000. You're losing $16,560 per year, or about $1,380 per month. This is negative gearing. However, you claim tax deductions for the interest, rates, insurance, and other costs. If you earn $90,000 per year and pay 32.5% tax, these deductions save you about $7,000 in tax. Your actual out-of-pocket cost is $9,560 per year, or about $800 per month. Plus, you claim depreciation deductions that save more tax. Meanwhile, the property is growing 6% per year, which is $36,000 in equity. You're paying $800 per month, or $9,600 per year, but gaining $36,000 in property value. That's a great return. Most investment properties are negatively geared, meaning they cost you some money each month. This is fine as long as you can afford it and the property is growing in value. Just make sure you calculate the real costs before buying. Getting finance for investment properties. Getting a loan for an investment property is different from getting a home loan. Banks are more careful because investment properties are higher risk. Banks will lend you up to 80% to 90% of the property value for investment purposes, though 80% is more common. They assess your income, expenses, debts, and credit history to determine how much they'll lend. Investment property loans typically have slightly higher interest rates than owner-occupied home loans, usually about 0.1% to 0.3% higher. Banks also assess your income more strictly. They'll look at your rental income, but they typically only count 80% of it because they assume some vacancy and costs. I strongly recommend using a mortgage broker for investment property loans. Brokers understand investment lending. They shop around multiple banks for you, and they know which banks offer the best deals for investors. Brokers don't charge you anything. They get paid by the bank whose loan you take. Get pre-approval before you start seriously looking at properties. Pre-approval means the bank agrees to lend you a specific amount subject to you finding an acceptable property. This tells you exactly what you can afford and makes you a serious buyer when you make offers. Common mistakes beginners make constantly. Let me tell you the mistakes I see beginners make constantly so you can avoid them. The first mistake is buying with emotion instead of data. You visit a property, you love the kitchen, you imagine yourself living there, and you buy it. But you won't be living there. Tenants don't care about your dream kitchen. Buy based on numbers and location, not feelings. The second mistake is buying in areas you know because they feel familiar. Just because you grew up in a suburb doesn't make it a good investment. Some of the worst investments are in suburbs people buy because they know them. The third mistake is chasing high rental yields in bad locations. A property in a mining town might yield 8%, but when the mine closes, you can't find tenants and the property value crashes. Good yields in bad locations are traps. The fourth mistake is buying new properties in outer growth corridors because they look pretty. These areas have huge supply and slow growth. You'll wait years to see any capital gain. The fifth mistake is underestimating costs. Beginners forget about strata fees, maintenance, vacancy, property management fees, and all the ongoing costs. They assume the rent covers everything and get shocked when they're paying $1,000 a month out of pocket. The sixth mistake is trying to time the market. Beginners wait for the perfect time when prices drop. Unless there's a major crash, you're better off buying a good property now than waiting years for a crash that might not come. The seventh mistake is not having enough buffer. Beginners stretch to buy the most expensive property they can barely afford. Then when rates rise or they have vacancy, they can't handle the costs and have to sell at a loss. Buy property you can comfortably afford. Your action plan to get started. You've learned the theory, now here's your practical action plan to actually become a property investor. Step 1. Get your finances in order. Pay off credit cards and bad debts. Save an emergency fund of $15,000. Start saving for a deposit. If you own a home, get it valued to see how much equity you have. Step 2. Educate yourself further. Read books on property investment. Listen to podcasts. Join online forums. The more you learn, the better decisions you'll make. Spend at least 3 to 6 months learning before you buy. Step 3. Get your borrowing power assessed. Talk to a mortgage broker and find out exactly how much banks will lend you. This tells you your realistic budget. Step 4. Choose your target market. Based on your budget, decide which city and what type of property you'll focus on. Don't look everywhere. Pick 1 or 2 cities and learn them deeply. Step 5. Research suburbs. Use online tools to identify 5 to 10 suburbs in your target city that meet your criteria for growth, yield, infrastructure, and affordability. Step 6. Analyze properties. Once you know your target suburbs, start watching properties for sale. Look at prices, rental returns, condition, and location within the suburb. Develop a sense of what represents good value. Step 7. Get pre-approval. Before you make offers, get formal pre-approval so you know you can actually get the loan. Step 8. Inspect properties. When you find properties that look good on paper, inspect them. Take a building inspector with you or hire one. Never buy without a professional inspection. Step 9. Make offers. When you find a property that meets all your criteria at the right price, make an offer. Don't be afraid to negotiate. Many sellers will accept below asking price. Step 10. Settle and set up. Once your offer is accepted, your lawyer handles the legal process. You arrange insurance, set up with a property manager, find tenants, and you're officially a property investor. The whole process from starting to educate yourself to owning your first investment property typically takes 6 to 12 months for most people. Don't rush it. Take your time, learn thoroughly, and make good decisions. Final thoughts. Property investment is one of the most reliable ways to build wealth in Australia. Millions of Australians have built significant wealth through property over decades. The fundamentals that have made property work historically are still in place: population growth, housing shortages, stable economy, and strong rental demand. But property investment isn't a get-rich-quick scheme. It requires patience, discipline, and smart decision-making. You need to buy the right property in the right location, hold it for the long term, and let time and compound growth do the heavy lifting. Don't be intimidated. Yes, property is expensive. Yes, it seems complicated. But people just like you with average incomes become successful property investors every day. The key is starting, learning as you go, and staying focused on your long-term goals. Your first investment property is the hardest. You're learning everything for the first time. But once you own one investment property and see how it works, buying the second is much easier, and the third is easier still. Many successful property investors own 5, 10, or more properties that have grown into multi-million-dollar portfolios. You can do this. Start with education, get your finances ready, choose carefully, and take action. Your future wealthy self will thank you for starting today.